Did you know that just 20% of Americans own nearly 80% of the nation's wealth? Imagine 20 people in a room controlling almost everything you see, touch, and use, from your smartphone to your favorite streaming service. What if I told you that by understanding this simple rule, you could make smarter choices with your own money? Today, we'll unlock the hidden power of the 80-20 wealth rule, show you why it matters, and give you clear steps to put it to work in your portfolio. Stick around. This could change the way you think about money forever. Let's start at the beginning. In the late 1800s, an Italian economist named Vilfredo Pareto noticed something interesting. In his country, 20% of the people owned 80% of the land. That pattern showed up again and again in businesses, in communities, and even in nature. Today, we call it the Pareto Principle, or the 80-20 rule. Roughly 80% of results come from 20% of causes. Example 1. In a company, 20% of customers often generate 80% of sales. Example 2. In your inbox, 20% of emails may contain 80% of the important information. It's not a perfect law, but it's a powerful lens for spotting where the real action happens. Fast forward to today, and the 80-20 rule looks even more dramatic. According to the latest data, the top 1% of Americans hold over 40% of all household wealth. The next 19% own about 40% more. Meanwhile, the bottom 80% share the remaining 20% of wealth. That means a tiny slice of the population controls almost everything. Why does this concentration happen? Let's break it down. There are 3 big reasons the rich keep getting richer. 1. Capital returns versus labor. Returns money invested in stocks, real estate, or businesses often grows faster than wages do. Economists call this R greater than G, meaning returns on capital exceed economic growth. If you own assets, your wealth compounds over time, while paychecks usually rise more slowly. 2. Network effects and scale companies like Apple, Amazon, and Google get stronger as they grow. More users attract more developers, more sales, and more data, all boosting profits. Small businesses can't match that scale. 3. Financial leverage and tax advantages. Wealthy investors often use loans and complex strategies to multiply gains. They also benefit from lower tax rates on long-term capital gains compared to ordinary income. That difference can add up to hundreds of thousands of dollars saved every year. These forces work together to drive the top 20% even higher, leaving most of us chasing scraps. But here's the good news. You can use the 80-20 rule in your own investments. Focus on the 20% of assets that drive 80% of your returns. Here's how. Track performance regularly. Review your portfolio and rank your holdings by return. Which 5 or 10 positions have given you the biggest gains? Those are your critical 20%. Double down on winners. Consider shifting more dollars into your strongest performers while staying within a sensible risk limit. If a stock or fund has delivered consistent growth, it may do so again. Use low-cost funds for the rest. For the remaining 80% of your portfolio, use broad index funds, or ETFs, at minimal cost. That way, you capture market returns without overpaying fees. Reinvest dividends and gains. Reinvestment supercharges compounding. Even small dividends, when automatically reinvested, can account for a huge share of your long-term growth. By zeroing in on your best ideas and automating the rest, you harness the 80-20 effect in your favor. A quick warning, the 80-20 rule is a guide, not a guarantee. Chasing hot stocks. Just because a position has soared doesn't mean it will keep going up. Always check fundamentals, revenue growth, profit margins, and debt levels. Ignoring diversification. Putting all your money into a single best idea can backfire. Even top performers can stall. Keep at least some exposure to different sectors or asset types. Overtrading. Constantly shifting money in and out of positions adds fees and can hurt performance. Set a review schedule. Quarterly is a good tempo. Use the 80-20 rule wisely with a balance of focus and safety. Let's wrap up with 3 clear steps you can take today. 1. Analyze your portfolio. Open your brokerage account and list your holdings by performance. Identify the top 20%. 2. Adjust your allocation. Increase your stake in those high performers up to a level that still keeps your total risk in check. Use low-cost funds or bonds for the rest. 3. Set a review routine. Mark your calendar for quarterly check-ins. Reassess which positions belong in your top 20%. Remember, small changes can lead to big results over time. By focusing on the handful of investments that truly move the needle, you bend the 80-20 rule to work for you, just like the richest Americans have done for decades. Thanks for watching The Dumb Investor. If you found this useful, leave a comment below with your top 20% positions, and stay tuned for our next deep dive into the psychology of market bubbles. And if you want to stop being a dumb investor, hit that subscribe button. See you in the next video.